Hi, guys. It's Dr. Robinson. This is the January 7th, 2023 update of the Money Masters Investment Club. Our itinerary today, pretty much the same. We are going to do a little bit of a corporate update here. I'll explain that, and I'll try to keep it as simple as I can, but we're also going to look at our financials. So let's go ahead and look at the financials real quick right now. For the week, we started December, the first day of the week in our previous session was 12/31/2022. NAV at that time was $26.51. We gained 48 cents on the week, ending NAV on 1/7/2023, 26.99. That translates into a 1.81% return. Pretty good return given that the trading week last week was only 4 days because of the holiday. So over a 4-day period, 1.81%, not a bad return for the week. We are still sitting on our strangle, a long-term strangle. The calls in that strangle are out of the money right now by $2.71. The puts are in the money by $4.01. That's leaving us an unrealized gain right now of $267,847.11. Now let's talk about an update here. Some of you know and some of you don't, but I've had some clients come in and they wanted to open an options account or do some options trading with me. And we've got about $50 million of money coming in on the option side. Because of that, because I'm really the only trader, the main trader that trades these options, I will have to significantly increase the size of our strangles going forward. Now, in and of itself, that's a good thing. The more money we have in a strangle, the better we're all going to be. But I'm going to increase significantly the size of our strangle. Given this, I have to implement a different strategy for distributions to redemptions because there's a bad thing that can happen when somebody makes a distribution on an unexpected basis. And I'll explain to you what I mean by that. So let me kind of go through this. So whenever somebody asks me for a redemption or a distribution from their account, whenever they do that, I make a redemption from our long-term strangle. Now, if you remember what I just did, it's just told you that our calls are out of the money right now, our puts are in the money. So when somebody makes a redemption, what I do is I take money out of the losing side. So right now, if somebody will call me up and say, "Hey, Richard, I need $100,000 out of my account right now," what I'm going to do is I'm going to go to the calls, they're out of the money, and I'm going to withdraw the $100,000 out of the call side. Now remember, what I'm doing there right now is making an unrealized loss a real loss. So effectively what happens is it harms everybody else by me doing this. So to prevent this from happening in the future where other people are hurt by somebody making redemption and we have to make an unrealized loss or a fake loss, if you will, into a real loss, I'm going to institute a policy to try to prohibit that or prevent it to some extent. So what we're going to do now, before I begin, by the way, we have to talk about the concept of delta. We don't talk about delta a lot. If you're on the daily call, we talk about delta a lot. Delta is what we call one of the Greeks when it comes to options pricing. There's actually several different things that affect the prices of options. If you're interested in the math formula for it, it's a formula called Black-Scholes. The guy who developed it back in the 1960s got the Nobel Prize in economics for it. It's complicated math, but when it comes right down to it, it really looks at about 5 or 6 different things that drive the price of an option. The most important being delta. Now, delta in the world of finance is nothing more than the rate of change of something. So if I wanted to say a number moved from x to x plus something, that plus something would be what we call a factor of delta. So if you're unfamiliar with the concept of delta, delta is the theoretical estimate of how much an option's value may change given a $1 up or down move in the underlying security or underlying market. Delta values range from a -1 to a +1. Now, if you have something with a 0 delta, that simply means that the option is not going to change price. The closer you are to the extremes, the better it is. For example, in calls, you want the delta as close to 1 as you can. Of course, a delta of 85 would be better than a delta of 25 because 25 is much farther away from 1. On the downside, the put side, the negative side, that's on the put side. But it works exactly the same way. If you're in the put side, that means you want the market to go down. The closer it is to a 1.0, the better or more money you're going to make on the down market. Conversely, if you're in puts and the market goes up, you're going to start your delta is going to start changing and going towards that 0 and then potentially into a positive number. Of course, if you're in puts, you don't want a positive number here. You want to stay, well, you're not necessarily going to get to a positive number, but you don't want that thing getting as close to 0 at all. The farther it stays away from 0, the better you are. So what happens is over time, the deltas of our option positions change. And as they change, from time to time, we have to go in and make some adjustments to them because they are changing. And one of the problems we have in strangles and straddles is that whenever we have an option position, sometimes that options position gets so far heavy one side that there's no protection for an opposite move in the market. I'll explain that in just a second. Let me give you an example. Let's say we have a call option. Now, I'm not doing this with the actual strangle that we're having. I'm just kind of doing this as an illustration. So let's say we have a call option with a delta of 0.6. Now remember, the numbers go from 0 to 1 on the call side. So a delta of 0 means the option is not going to change price or change prices as the market moves. It's just the option is just not going to change. It's basically dead. An option with a value of 1.0 is going to change $1 for every dollar, or it's going to match the market effectively. It's going to change $1 for every $1 move in the market. Well, as I said earlier, when we get into options trading, we usually start out with a delta around 50. It's a good place for it to start. It's still got enough delta in it to kind of rise, but it's also got low enough delta that if we have to get out of that trade, we're not going to lose a lot of money because occasionally we get on the wrong side of the trade. So if we do a 50 delta and the delta ends up at 40, we can bail on that and still not lose all of our money. So I like a 50 delta. But let's go back to our example. A call option with a delta of 60 will move 60 cents for every $1 increase in the underlying. So if it's the market or a stock or a bond or whatever it is we're doing the option on, if it moves up $1 and you have a 60 delta, that option will increase in value by 60 cents. So in other words, an option that costs $1.50 will increase to approximately $2.40 if the underlying instrument goes up by $1. That's 60%. So you buy something at $1.50, if the market goes up by $1, that option is now worth $2.40. Now, I will caution you this is an estimate. It's an approximation. The reason I can't tell you the exact number is because there's remember I told you about the Greeks. There's things like gamma. So not only do we have delta is the most important, but we do have gamma, we have theta, we have rho, we have nu. So we have some other things that affect the prices of options. But I'm kind of discounting those because those are lesser things that have an effect. So they do have an effect, but it's lesser than delta. Delta is the big one. So if I start out with an option with a 50 delta at $1.50 and the market goes up by $1, my investment is now going to be worth $2.40. On the other hand, and let me kind of contrast this with the low delta. Some people like to buy low delta options. Now, if you've got time or if you're willing to wait a long time, that's not a bad strategy because low delta options are very cheap. So on the other hand, a call option costing $1.50 with a delta of 25 will only increase to $1.87 if the underlying instrument goes up by $1. So you have two options here, two call options. One of them, or both of them, you paid $1.50 for, but one of them has a 25 delta, the other has a 60 delta. So the 60 delta is going to grow faster because it has a higher delta. Remember, that's the rate of change. It's going to grow faster than an option with a delta of 25. So we don't like those low deltas. They grow too slow. And remember, for what we do, we're mostly in the market and out of the market in the same day. In fact, about 99.99% of the time. We're in, we're out. We don't have time to watch a delta go from 25 up to 50 to 60 to 70, assuming that the market goes that way anyway. So we just don't have the kind of time that it takes to watch a delta go, an option go have a delta with a 25 going up to say 30, 35, 40, and ultimately maybe up to 50 or so. It will increase in value, but it's going to take so long, and it's probably going to take a couple of days as a minimum. So when deltas get too low, we don't have any use for them for what we do. So how does that impact us on angle? So what this means is every once in a while when we're in a position, I have to make a change to our positions. Now remember, a strangle or a straddle means I'm buying both sides of the trade. I'm buying calls and buying puts. Because I'm buying them on both sides, over time, the market's going to move one direction or the other. For example, in our current strangle, the market has been moving down since November. Because it's been moving down, our puts are getting in the money by a lot. They're growing really fast. They have a delta right now of about 78. So we've got a delta of 78 on our puts, but our calls have got a delta of maybe, and I don't know the exact number right now, but let's just say 25. So our calls, the delta on our calls is so low that if the market were to suddenly come up, spike up, like it did on Friday, because that made me a little bit nervous. So if the market on Friday spikes up on some good economic news, our call delta is so low that our calls are not really going to go up in value that much. Now, I'm not saying they won't go up in value at all. They will, but they're going to come up very slowly because our delta was so low. On the other hand, our puts that have the high delta are going to come down in value a lot faster. In fact, about 40% faster than they're gaining anything on the calls. So it's important from time to time that we adjust our deltas. Now I do that behind the scenes and you guys never see it. It's just one of the things that I do. Now I do it on average about every 4 to 6 weeks because it takes about 4 to 6 weeks for those deltas to get way outside of each other. Now remember, we like those deltas to be apart from each other. I want to see one of my deltas get to 1 and I want to see the other one go down to 20 or 10 or even 0 theoretically. The farther apart those deltas are, the more money we're making. The downside of this, of course, is that if the market does reverse course, we now have an option that has no delta. If the delta goes down to 0, it's just not going to move no matter how much the market comes back the other way. So what I have to do is I have to chuck that option, whether it's a call or a put. I get rid of it and buy a new one or a new set of options with the 50 delta. So let me show you an example. Let's say we open a position with 100 calls, and I'm just going to keep this pretty simple, guys. Let's say we open a position with 100 calls priced at $1.50 with a delta of 50. At the same time, we buy 100 puts as well. They also have a delta of 50. This position is known as a straddle. This is not a strangle. Strangles are a little bit different. A straddle is just, we call it a straddle because the strike prices are exactly the same. If the strike prices are different and you're buying both sides of the trade and the strike prices are different, that's called a strangle. Now, a straddle will always eventually become a strangle because we have to make those adjustments as I've been talking about. But let's pick it up from this straddle that we've got. I paid $1.50 for 100 calls. I paid $1.50 for 100 puts. So in this investment, we've invested basically $3 on this position. Now, at the end of the day, we don't care which way the market goes, because if the market wants to go up, the calls are going to become more valuable, the puts are going to become less valuable. So at the end of the day, we don't care which way it goes. That's the whole purpose of a straddle or strangle. But in the meantime, this position cost us $3. Let's take this forward. A week later, the underlying market has risen by $1. In other words, calls are more valuable, puts are less valuable. That means the delta on the calls has risen, the delta on the puts has declined. So a week later, the underlying market has risen by $1. The calls would rise from $1.50 to $2.40 and now have a delta of 60. So you can see a week later, because the market went higher, we increased, or the value of our call increased. Unfortunately, the value of our put decreased. So on the other hand, our puts would fall to approximately 90 cents in value. So we bought them at $1.50, but a week later they're only worth 90 cents, and the delta has fallen from -50 to a -40. Now remember, they're always going to have a negative sign in front of puts. Um, the delta on that is, basically a negative number. But at the end of the day, this is kind of what we want. Now, this is why, by the way, and this is the exact reason I get a lot of people asking, hey, should I buy straddles or strangles? Because I think the Fed is going to have an announcement at, say, 2 o'clock on a particular day, and there's going to be a lot of volatility. The problem with that mentality is that straddles and strangles are expensive to start with. Remember, we've invested $3 here. And for there to be a significant move, a big enough move to justify or to increase the value of one side over the other, it usually takes time. So we think of straddles and strangles as longer term options. These are not things you do on a one-day basis. They're not even things you do on a 1 week basis. I'll show you that in just a second. These are things you hold for a month, 2 months, 6 months, 9 months. You hold these for longer periods of time because it takes a long time for those options to get farther apart from each other. We're just trying to watch those deltas get farther and farther away from each other, or prices to get farther and farther away. The more they, or the farther they get away, the more money we're going to make in a position. And again, I don't care which way it goes. I don't care whether it goes up or down. I just want those two numbers to separate from each other. So let's kind of pick this up from where we're at. So we've got our calls have gone from 150 to 240. The delta is now 60 on the calls. On the other hand, the puts are now falling down to 90 cents in value with a delta of 40. So let's go out one more week. Another week later, the market has risen another $1. So from here, our calls are now worth about $2.55 with a delta of 70. The puts are worth 60 cents with a delta of 40. So the delta has come down a little bit. Now our net position has increased from $3 to $3.15. Now that's not a huge difference. That's why I tell you that strangles and straddles are not short-term things. It takes time for these things to develop. But if you give them enough time, they will start to make a lot of money. But at this point here, we are 2 weeks into the strangle. Our net position is relatively small. We've made 15 cents overall, so we've got a 5% gain. Now, 5% over a few weeks isn't all that bad, or over a couple of weeks anyway. Not all that bad, but you're not going to get rich on 5% unless you can do 5% a week every week for years. But that's a different story. Let's take it let's go out a month. The market over a next month, the next 4 weeks, is up $5. The calls are now worth about $5.10 and have a delta of 1. Now the delta here can't go any higher, but that's a good thing. That just simply means that every time the market goes up from here on, it's a 1-for-1 move. If the market goes up another dollar, our options go up another dollar. So it's not 60% anymore or 50%. It's basically dollar for dollar. Market goes up $10, our options go up $10. So the delta here now is at 1, and the value of the options is $5.10. Notice the puts. Now remember, we bought the puts at $1.50. We've got some losses here. That's why I tell you that when we look at options, or when I give you the options on a weekly basis, I tell you that some of our options are out of the money. So right now, it's our calls that are out of the money. It just simply means the market's been going down, so the delta has been rising on our puts, but the delta has been falling on our calls. So we're losing money on the call side. But in this example, I did the opposite. I just simply said the market's going up. So the puts have lost delta and they've lost value. The puts are only worth 30 cents right now. And they now have a delta of 20. But let's look at the net position. Remember, it's now been, 6 weeks or so. So we did a month, we had a couple of weeks in there. So we're 6 weeks later. What's our net position? Well, remember, we bought both sides of the trade at one point for $3. But now they're worth $5.40. We've had an 80% gain in about 6 weeks based on the movement of the market. Now, of course, I did this in a simple, the market doesn't move in straight lines. I mean, it can, But when I give you an example that the market went from, went up another $5 in a 4-week period or something, I'm exaggerating it because the market is constantly going up and down. It's just the trend lines. Now, trend lines on options, as I said earlier or alluded to earlier, are longer. Therefore, we use longer trend charts. We don't use the charts that we use on a daily basis. I'm not using, let's say, a 3-minute chart or a 5-minute chart on a daily basis because I need to know what the fast trends are, the daily trends are. When we're doing straddles and strangles, we go out 3 months. So we look at what the trend is doing over a 3-month window. That's way too long of a chart for us to use on a day-to-day basis. But in a strangle, that's the perfect chart. We use typically a 3-month chart to kind of see what the market's doing over a 3-month window. And of course, for the last 3 months or so, it's been mostly down. That's how you make money in the options. Here's my at this point, that 20 delta is too low. It's so low that if the market did spike down, so we had all those gains because the market was going up and up and up, and then let's say one day the Fed comes out and says we're going to raise interest rates by 250 basis points. That would be huge. Well, it's not huge, but it actually would be huge. If they're going to raise interest rates by 250 basis points, I'm going to tell you right now, the market's going to just crash. But now you have no protection because your puts are at a 20 delta. So you're going to lose thousands of dollars of profit out of those 80% of profits we had. We're going to lose most of it before the delta on the puts rise enough. They will rise. But it's going to take so long that most of our profits are going to be gone, and we're going to end up losing all of that money before those puts are valuable enough for the delta to rise to kind of make some money on that side. We don't want to do that. So what I have to do from time to time is I have to go in and get rid of those 20 delta options. And what I'm going to do is I'm going to buy something with a 50 delta. So at this point, the put delta is too low to protect our straddle should the market suddenly spike down. So before anything happens, I sell the puts for their intrinsic value. Now remember, they still have about 30 cents of value. So I sell them in the market for 30 cents. And then buy an additional 100 new puts with a delta of 50. So what I'm going to do is I'm going to roll over my options. I'm going to get rid of those deltas or those options with a delta of 20 and replace them with an option with a delta of 50. The reason for that is now if the market spikes down, I don't have to worry about waiting for options with deltas of 20 to come up to 30 and then 40 and then 50. I've already got a delta at 50, so if the market spikes down, those options are going to go basically to almost 1 fairly quickly. So I can that way, or what I end up doing here is I have a chance to keep my profits on the call side, and if the market does come down, I have the movement or the upward movement of the puts to compensate me, or to going back to a class we did a few weeks ago where we talked about hedging. This is all I'm doing. I'm effectively hedging my new position. I'm raising the delta so that if the market does want to come down, those deltas have a 50, or those options have a 50 delta. If the market comes down, it's going to go to 60, it's going to go to 70, going to go to 80, and go to 100. And that way I don't lose any of those profits I have. Now this, because I'm buying a new set of options, and the strike prices are going to have to be different because those other options that have a 1 delta and they're a lot more valuable now. They're at 540, and I don't want to buy 540 puts, so I'm just going to buy a new put with a delta at 50. That's where we create a strangle, because now the strike prices are different. So now we have a strangle instead of a straddle. So this changes our straddle into a strangle since the strike prices are no longer the same. So now what we have are calls with a delta of 1 because the market was up. But now I've gotten rid of those puts with a delta of 20, replaced them with a delta of 50. I still have an upward bias in the market, by the way. You'll notice there in that second paragraph, it says, since the call delta is still higher than the put delta, 1.0 to 0.50, I have an upward bias in the position, meaning we'll still make more money if the market continues its upward trajectory. So I don't want to equalize the deltas at all here. A lot of people ask, why don't I buy a delta with a 1? Well, it's going to be so expensive. I could, but it's going to be so expensive. It's going to take just about all the profits we made to get into that position. And then all you've done really is created another strangle. So strangles, by necessity, to make any money, especially over time, strangle has to become a straddle rather has to become a strangle. So at this point, I buy the new in this case, puts with a 50 delta, just for protection, just in case the market does want to come down for, based on any kind of news that might hit the market. Now, when I do this, when I make these updates to the deltas, I can time any investor redemptions to the purchase of the new options. So if I know going ahead or going into this that somebody's got a $100,000 redemption they want to do, I can time the sale of the old options, the 20 delta options, to the timing of a redemption. And that way, we're not going to cut loss or any profits out of a thing. We're going to do this anyway, and I can kind of absorb the cost of this redemption inside our changing of the options that we're using to hedge the position, which means other investors aren't going to be harmed by another person's redemption. The problem here is I have to have advance notice. A lot of times what happens is somebody comes up and says, hey, Richard, I need $100,000, but I need it tomorrow. When you need it tomorrow, now what I have to do is I have to go in and redeem the, in this case, the example I've given you, I'm going to redeem the puts, but I'm going to redeem the puts, and maybe the puts haven't gone all the way down to 20 yet. Maybe they're only at 30, 35. I'm not going to change out options with a 35 delta. Yeah, that's getting low, but that's not really low. So I'm going to let them go even further. But if I have to change them out at 35, I'm wasting money because I have to pay. You remember the price of an option is based on where the delta's at too. The higher the delta, the more expensive the option. I'd much rather replace 20 delta options than to replace 35 delta options because it's going to cost me a lot more money to buy a 35 delta option as opposed to a 20 delta option or to redeem. So at the end of the day, I don't want to have to pay for expensive options to do this. And if I have to redeem a 35 option, delta or delta option, it's going to cost me a lot more money, and I'm not really getting any benefit from it. For example, if I have to replace a 35 delta option and I'm only changing it up to 50, I'm only gaining 15 basis points of protection. That's not enough to justify the cost. And again, that's going to be still a fairly expensive option when it comes to buying that. So at the end of the day, if you don't give me any advance notice, I have to buy an option that's more expensive than what we would really want to pay. And there's very little benefit in changing an option with a delta of 35 to an option of 50. Yeah, there's 15 basis points difference, but that's not enough to justify the cost. Because in all honesty, a 35 delta option can come up pretty quickly. It's still got 35% value. And an option gets to 20 or 15%, that's almost impossible for that option to really move significantly in any one direction unless something really, really big happens. Now, it does happen. It's happened in the past when, with the Japanese earthquake back in 2000, I think it was 12. We saw options that had deltas at 5 and 10. All of a sudden, they're at 60 and 70. It does happen, but those are anomalies. Those are big market, we call them exogenous risks. Those are huge exogenous risks to the market. That doesn't happen every day. So on a normal day, if I've got to change out a 35 option for a 50 option, it's going to cost us money. And unfortunately, I have to spread that cost out amongst everybody. Sorry, excuse me for that. And that's what I'm trying to avoid, guys. So what I'm saying here is if you want to make a redemption, you can. It's your money. But if you're going to do it with an unexpected or, without telling me in advance, and I don't have any chance to kind of time the redemption to the purchase of newer options with that 50 delta, what we've decided to do with the board of directors, so without the advance notice, I can't time the transaction resulting in prematurely redeeming the lower delta option at a higher cost, causing a net loss to our overall position. To avoid this, any investor making a full or partial redemption without advance notice Now, the advance notice, I haven't put it down in writing. I'm kind of mentally, I probably should, and I think we probably will in the next board meeting, but I think 30 days minimum would be about right. Keep in mind, I do renew or redo our options about every 4 to 6 weeks. But I think a minimum 30 days would be sufficient for me to say, okay, so if you give me 30 days notice, I can time the redemption properly. You're not going to suffer any losses. If you do a redemption before the 30-day window and you don't tell me in advance, so if you don't tell me you're doing the redemption, then whatever loss we've incurred with redeeming the option, I think should be borne out by the investor taking the redemption. It's only fair. In other words, the other investors shouldn't have to subsidize the losses of someone who's made an unexpected redemption of their account. So I don't want to make it sound, and my fear, guys, and this was true of the board of directors, some of the guys on the board, the fear is that some people are going to be like, well, he's just trying not to give us our money back. That's not it at all. We just want to make sure that when you want your money back, you give us enough time to get into a position where we can give you the money without hurting everybody else. So 30 days is generally going to be enough. If we find out in the future that maybe we need a little bit more time, I don't see that happening, but we can always extend it, or we can always shorten it too. Sometimes, maybe we can get to a point where we need 21 days, so 3 weeks notice or something. But right now, I think what we have to do is do a 30-day announcement or 30-day advance notice of a redemption, just so that we can kind of get our ducks in a row and not have to hurt everybody, not have to make sudden losses. Now, keep in mind, I understand life happens, and sometimes an emergency happens, and you've got to have your money, and you got to have it now. The downside of that is that I don't know where we're going to be. There's no way to predict how much it's going to cost somebody to absorb any of those losses. It might be just a few pennies, could be several thousands of dollars. For example, I just recently did our newest update on our options because our deltas had gotten down pretty low. So right now, if you were to do a redemption, the fee or the cost of that would be fairly high because I'm redeeming old options for new options, and they would be slightly more expensive, not a whole lot more expensive, but we're in a position where we've already done it. So I don't know when somebody's going to do a redemption. You might do a redemption a week after I've already done the changes. You might do it 2 weeks after. But the closer you are to where I'm doing my updates on the deltas, the less impact it's going to have on somebody. So for example, let's say you do give me the 30 days notice. Well, 30 days, I know that I'm going to be changing out the options anyway. And if I'm changing out the options, it's easy to redeem your money and not have any costs. But if you make me do it midway through, the change could cost you two, three, four, depending on the size of your account, how many shares you have, could cost you several $1,000s. So I just want you to be aware of that. It's the only way to make this fair. Keep in mind, guys, if you have any questions, if you have any concerns about it, give me a call, give me a text, whatever, and we can certainly talk about it. But this is a change that we have to do simply because when we bring all this other money on and somebody wants to do a redemption, and keep in mind, think of it from the other point, not maybe thinking about you doing a redemption. Let's say somebody comes in with 50 million and that person comes in and says, well, hey, I need 10 million out. Me having to do a $10 million redemption on, unexpected, unannounced type of thing, and I'm going to have to take a huge loss on an existing position, and that's going to affect all of us. So your shares are going to go down in value, my shares are going to go down in value. It's just a hit to all of us. So keep in mind, we're doing this to protect everybody, not trying to keep anybody from getting their money. I don't want that to, that's not even a consideration. It's your money. You do whatever you want with it. But if there are losses, you're going to have to absorb them if you haven't given us any notice. And I do this for that, I'm worried about the $50 million coming in. I just can't take a chance that somebody puts in 50 million and then, comes along and says, in maybe a month or 2 months and say, this is not for us. And they want to take 40 million out. And the next thing you know, we got to do a redemption on $40 million worth of strangle. And we've all got huge, and, the losses could be huge because maybe they do it in a couple of weeks, by the way, and the strangle hasn't had any room to kind of run. And now we've got huge losses. So we're doing this to protect everybody. But again, if you have any questions about it, give me a text, give me a call. We're going to institute this pretty much immediately, just to protect everybody from anybody doing anything kind of crazy, putting us in a position where we have huge losses and other people have to suffer for what one or two people have done. So at the end of the day, that's my update for the week. Sorry it went a little long. I know it's about 35 minutes right now, but I tried to make this as simple as possible in describing deltas and things. But at the end of the day, admittedly it's complicated stuff, but not terribly complicated. But people who don't do this on a day-to-day basis, it can be confusing. So again, if you have any questions, let me know. And other than that, we'll see you next week. See you later, guys.